Emerging markets like China, India, South America, Africa have all taken a bit of a beating this week. But is this justified? And what the hell is going on in China?
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul. I'm brand new to investing and I've started a dividend reinvestment portfolio on Trading 212. This channel is designed to document my investment journey right from £0 all the way up to whatever I can make, with the goal of eventually maybe achieving some sort of financial freedom. This week, my portfolio is worth £33,757, and that's down from about 1% last week. This is because my largest holding is the Vanguard FTSE Emerging Markets ETF. This is an index fund which tracks the emerging market. And just this week, and I'm only on Tuesday right now, VFEM is down 7%. So I dread to think what this is going to be like in 4 days. And VFEM is made up of all the emerging markets, but it's heavily weighted towards China. And China this week has been having a terrible time in the market. The most recent news is China making a few alterations to the way tutoring companies and schools in China can make money. Basically, they're not allowed to anymore. And apparently this was a shock to the markets. And this sent some Chinese education companies like TAL Education Group down 81%. However, if you're invested specifically in TAL or New Oriental, this should not be a surprise to you. Back in June 2020, it was being well recorded that some of the teachers in these education groups were being harassed, and that some of the regulators were not happy with the way some of these companies were teaching Chinese children. And between April and June, most TAL investors had already realized this and got out, leading to a 38-point drop. That's in comparison to this week so far, which is only a 20-point drop. But this is just the latest story in a ton of terrible stories for China. And there are other stories like Xi Jinping not getting on with Jack Ma and stopping the anti-IPO, and ride-hailing service Didi, which investors really should have known about what was going on with Didi before its IPO. Chinese regulators had already warned Didi not to go IPO, and this was in its S1 filings as well. So there are a lot of things that people are blaming on the Chinese government, but they already knew they were happening. And Cathie Wood added another nail to the coffin by warning of a valuation reset in Chinese stocks, all because of recent poor relations between US and China. However, Cathie Wood is useless at investing in Chinese stocks. The green bars here are every time that ARK Invest decided to buy into Alibaba, and the red are every time she sold. And ARK Invest in Alibaba has been absolutely diabolical. And I know over the past couple of days, right up until Friday probably, they have been selling Alibaba. ARK Invest is pulling some of the worst kind of investing on Chinese stocks right now. Simply buying high and selling low. It doesn't make sense. And famous CNBC investor Jim Cramer also has a very poor short-term outlook for Alibaba.
What are they going to do with Alibaba? Is Alibaba okay? They have American financials. It's always been transparent. Or is Alibaba just another company that they think the rich people have benefited from? So I think this is an attack on the rich, and it's an attack on people who are creating content that is not becoming of the Chinese Communist Party.
I think he has a point. There's a lot of things here which are very Chinese-esque, grabbing onto that control and trying to keep its people in check. Alibaba is a great example of this right now. It usually trades at a PE of 30, which is great because Alibaba is one of the biggest tech stocks in the world. When you're thinking about Alibaba, don't just think about AliExpress. Don't just think about it competing with Amazon. It's a massive conglomerate and it has lots of different huge companies within it that all compete with the biggest American companies. And put simply, with its massive cash flow growth, 46%, 27%, 28%, 52%, 26%, and 26% estimated for 2023, this company's free cash flow growth is absolutely incredible. The lower that this price goes, the more the fundamentals stand out on Alibaba and the more it makes it a screaming buy. But I can understand why investors do not want to be in single Chinese stocks right now. They're very hard to understand. We don't actually know what's going on with these companies when they're over and abroad. The only news that we get about them is probably filtered through the Chinese government. Most Chinese 10Ks are also given to you in renminbi, which is the Chinese currency. Alibaba is a little bit better because it gives you some US dollar numbers, but most of it is still in renminbi, which is quite hard to read. But if you truly believe that the stock market is volatile short term, but in the long term, cash flow generated from these companies is what eventually drives the stock price, then I haven't seen a price drop like this in comparison to earnings and revenue growth since Amazon in 2000. And if we keep analyst estimates followed by a 10% continuous growth rate and a PE terminal value of 20, this is a super conservative report on this. You can still earn a total annual return every single year of 11%. But we don't just have to look at individual companies like Alibaba, JD or Didi. We can look at the emerging markets on a sector basis and still see some pretty good stuff. Because again, the headline news this week is that China and the US had a pretty bad meeting and they didn't really come to a decision. And on the day, VFM fell 3.5%. It probably will go lower over the course of the week. But the truth is there's always a problem between China and the US. 1972, things got a little bit better. But ever since then, there has been constant, and I mean constant, tensions and massacres and loads of different tension events that completely crushed the market. In 2012, Barack Obama caused a lot of crap with China. And according to the emerging markets MSCI, we dropped 31%. In 2015, another huge drop, all because we thought we were going to war with China. And then believe it or not, because Donald Trump was in, everything got much better.
China, 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 China.
And the emerging markets seem to follow the same rules as every other market. We always see higher highs and higher lows. We don't get ridiculous crashes that destroy the market forever. Even though the US and China have been at each other's throats for decades now. To me, recent events are just another blip on a massive timeline. The short-term share price of Chinese stocks is all driven by story. For a long-term perspective, we need to look at the numbers. Numbers like China's gross domestic product, which has gone from 1 trillion all the way to 14.5 trillion in just 2 decades. That's growing a little bit quicker and it's far less volatile than the US GDP. And then we have JP Morgan's Guide to the Markets, which I think is an amazing document that comes out quarterly and gives amazing insights into what the markets are doing right now and how much countries are earning. They always have an emerging market section and the information in here is incredible. And when you've got massive GDP growth in your country, it means your population are going to get much wealthier as well. And we're starting to see a rise of middle class in India, Indonesia, China, Brazil, Mexico, all expected to grow 70 or 80% by 2030. Most of this is going to come from India, with 1/3 of it coming from China alone. And if you have a look at Europe, places like the UK, it could be that in these countries we're going to see a decline in middle class, which if I'm honest is something that's quite scary. And GDP growth of China as a whole has improved vastly.
When I look at how much the United States borrowed from their future, and when I look at what Asia and how they've handled it, I just think they're the big winner coming out of COVID. And even within specific areas like tech, Intel's thrown in the towel, so Asia owns Foundry. They own memory. They're ahead in robotics. I just think the next 5 years or so, Asia looks a lot better to me than the United States, because at some point we got to pay back in terms of productivity, in terms of higher rates, in terms of a lower dollar for all these transfer payments we've made the last 9 months, and it looks like we're going to continue to make. So I'm quite constructive on a number of names in Taiwan and Korea and China. I guess like the rest of the world, we own C in Singapore. But I just think long term, I don't know about the next 2 months. I'm unfortunately right with the consensus. I think Asia is going to be an outperformer, their equity market versus the U.S. and especially their currency market. Again, I mentioned it, but China's done virtually no QE the last 2 years, while our QE to GDP has been like 14%. Their real yields are higher than ours. They continue to run a current account surplus. I'm sure you saw in the Financial Times this morning that net investment into China actually passed the U.S. for the first time ever this year. And I just think it's the beginning, not the end of a trend.
China has not placed that much money into its economy from the government, unlike the US and the UK. It's also in 2021 seen an 11% rise in the consumption section, which is more evidence of a growing middle class. And perhaps most importantly, while companies like Amazon and AliExpress did so well during 2020, it seems that their exports rose 2.2%. That would be all the cheap Chinese crap you keep ordering off Amazon and Wish. And perhaps the most outstanding information here, particularly for a company like Alibaba, is that consumers that spend on Chinese Single Day outspend all Americans that spend on Prime Day, on Black Friday, on Thanksgiving, and even Cyber Monday, all put together. So if it's a little bit too confusing or you just don't trust single companies in China, it may be better to invest in total in an ETF. The emerging markets ETF that I invest into is the Vanguard one. That ticker is VFEM, but there are many others, all that you can find on Trading 212. VFEM has a cost basis of 0.22%, and it pays a dividend of 1.7%, but that may have risen to more like 2 or even 3% with the recent drop. What I think is amazing right now is that according to Vanguard, the price to earnings ratio of VFEM is only 10.6, and the price to book ratio is only 2.3. With VFEM, you are taking on a high exposure to China of 41.5%, 16.2% in Taiwan, and 12.4% to India. I would love to see a little bit more weighting towards India and Brazil, maybe even all of South America, to be honest with you. And the thing with broad-based ETFs is they aren't just as simple as buy and hold forever. Even in the biggest, broadest index funds, you should still try to understand at least the top 10 companies in that index. With VFEM, I feel quite happy holding Taiwan Semiconductor, Tencent, Alibaba, Meituan, Vale. Vale's an excellent mining stock. And if you think all of these companies as a whole are undervalued, then this might be the sort of thing for you to buy. Particularly with VFEM at a 10.6 multiple when the S&P 500 is at 34 times earnings, I think I might be getting a good deal here. Thank you very much for watching again. I'll see you on the Instagram and Discord. And if you enjoyed this video, please feel free to give it a little like, subscribe, and invest.